What is up, team? A very confusing piece for me as an early trader and investor back when I was starting was understanding financials of a business. Last night's episode, I said that we were going to cover the financials of NVIDIA as, in spirit of their earnings that are being released on Wednesday. So today I'm going to show you in under 10 minutes the simplest way to understand the financials of a business so you yourself can get promoted as a trader and investor, so that when you look at the financials, you'll have full scope of what's going on with that company rather than relying on articles or YouTubers or so on. So the idea here is the next 10 minutes that you're going to walk away with the knowledge you need to properly assess if a stock is a good buy financially or not, or where the risk lies in that company. So let's get right to it. NVIDIA is announcing their Q3 earnings on Wednesday night. I just go to Google Finance here. It's a free tool. I want to make trading accessible to everyone, so this is the tool we use on this channel. And if you scroll down on any stock, you can see the financials, the income statement, the balance sheet, and cash flow. Here's all you need to care about. We call it the Blom 7. Only 7 of these numbers matter. Number 1, very important, revenue growth. Revenue is just simply how fast the company's sales are increasing. You want to see it growing, that means the company is growing. This is a year-over-year comparison compared to Q2 of last year. I guess we're looking at the July earnings. So they grew 55% year-over-year in that quarter. That is really high growth. The second thing you want to look at is net income. So that's essentially profit, but it gets a little confusing because this is accounting profit, not real profit. So this number can be sort of manipulated depending on when taxes are paid or when they invest in building a new factory and so on. The long story short is you do want profit going up. That is very healthy to see that number going up. You also want to, this is maybe an honorary number, operating expense. They're spending more money to grow the company, but they shouldn't be spending more money to grow than they're already making. So this is healthy. We see a 55% growth in revenue year over year. We see a 59% growth in net income or profit year over year. And they're spending more money to grow the company, but it's not outpacing what they're earning. What you care about is revenue, and you care about net income. The last thing you care about is profit margin, net profit margin. This reads as a percentage. 56%. So it's going up 2.3% year over year, which means they're being more efficient this year than they were last year by a small margin, and they're making more profit margin. 56% profit margin, that's insane. That is really good profit margins. This is why NVIDIA is the biggest company on the planet right now. These numbers are wild. So in this first section, is revenue growing? Is profit growing? My mouse is frozen. And then, is the profit margin growing? Are they becoming more efficient? Check, check, check to all 3 of these. The second, or I guess the 4th and the 5th number that you need to care about here are cash versus total liabilities. The top number is their cash. This company, NVIDIA, has $56 billion of cash sitting in an account. They are cash rich. But the question is, versus liabilities, how much debt do they have? Total liabilities, $40 billion. They have enough cash in their bank right now to cover every single debt they have. That is super strong. You can also look at an honorary number here is total assets, which means you want to see a company, they have $140 billion in assets and offices and equipment and data centers and manufacturing facilities, and they only have $40 billion in debt. So that is also really healthy that they have way more assets than they have liabilities, but they have enough cash to literally pay off every single debt they have. That is super strong. So you're looking at cash versus liabilities. Check, check. In the cash flow sheet, these are the most important 2 numbers in the entire financial report. Cash from operations. how much money did they actually get paid from customers in that quarter? $15 billion. Free cash flow, this is the profit. How much cash did they profit? So this is why this is important. If we scroll back up to revenue, they're saying they made $46 billion in revenue in this quarter, but then how is it possible that they only made $15 billion in collected payments? Because cash is king, cash is what customers actually paid them. What they can do with revenue is a bit of an accounting number. We can sign a contract that says for the next year or the next 5 years, I'm gonna sell you $2 billion of NVIDIA chips every single year. So we can contract next 5 years, $2 billion a year. I can contract $10 billion of revenue that we earned because it's contracted, but it's not in the bank yet. So that's the difference between revenue and cash from operations. This is actually how much, because you could have a company say that they have customers who are going to pay them $300 billion in the next decade, but what really matters is are the customers actually paying them. So that's what this number is, cash from operations. Same thing with free cash flow. This is actual profit, $6.66 billion that gets added to their cash that quarter. But they're saying up here, they made $26 billion in profit. This is an accounting number for accountants. They didn't actually make $26 billion in profit. That's, based on the revenue they earned and expectations, and they can, pay taxes in some months and not in other months, and pay for equipment in some months and not for other months. So this number can be adjusted. It's not truly accurate to how the company's performing. That's why this last number here, free cash flow, is super important. Do they have higher free cash flow? And they were actually down that last quarter a little bit. That could have been for a number of reasons. Maybe their payments weren't due that quarter, and more payments were coming in Q4 or Q3. So to summarize, let's bring this all full circle. Is revenue growing? Yes. Is profit growing? Yes. Is the profit margin growing? Are they becoming more efficient? Yes. Does the cash they have in the bank outweigh the liabilities? Yes, they can pay off every debt with the cash they have. What is their cash from operations? Is that growing? Yes. Their actual profit margins were down a little bit, so they didn't pocket as much, so they're not truly as efficient, or they maybe didn't collect as many payments in that quarter as they did other quarters, but they're still making a ton of cash here. 6.6 bill is insane, and that's getting added to their cash and investments. So this is what you look at. Now, not every income statement is going to be as clean and as green as this one. There's going to be some where maybe they don't have a lot of cash on hand, but they do have a lot of liabilities. So there's risk. There's literal bankruptcy risk that if they run out of cash, they might not be able to pay their debts. But it's maybe a growing company and they're showing a lot of revenue growth. And so you're like, well, maybe they can outgrow the fact that they don't have a lot of cash in the bank yet, and so on. So when you look at every other company, you can start to do the math and say, okay, this is where the opportunity is. This is where the risks in this company are. Is it worth my money? Another number that is very, very important is your price to book ratio. I'm actually going to add this into the description of this video, what it means. So essentially, a 1 price to book ratio means that the company is investors are willing to pay exactly what it's worth on paper for that company. So anywhere from a 1 to a 3 or a 4 is quite low. That is typically like energy companies, manufacturing companies, companies that don't have hyper growth. They're quite steady. They grow slowly. Their price to book ratio might be a 3. Anywhere from like a 6 to a 9 is quite high. A lot of tech stocks sitting there. They're basically saying, okay, like this company needs to keep growing drastically. They need to keep showing good earnings because we're paying a lot for these stocks per what the company's actually worth. So we need to see continued growth for the stock to be worth it, for me to continue holding the stock. Anything above 10 is high. 45 is absurd. I think Palantir is 66 right now. So this means that there's so much hype around this company that perfection is basically priced in. If they fall short in any category, investors could get spooked and pull their money out. So what they're just investing in here is hyper growth and showing just like more revenue growth, more profit growth, more cash flow growth. So this is an insanely high price to book ratio. There's probably not a ton of companies that are too much higher than this, especially not in the Mag 7. I think Amazon is like a 7 PB ratio, whereas NVIDIA is a 45. So when we look at this, it's like, okay, they have really healthy earnings, but they need to keep growing at this rate because that's priced into the stock. If they even have good earnings, but they slow down their growth a little bit, that could cause a downturn in these earnings. So that's basically how you understand the income statement, the balance sheet, and the cash flow. All of these reports are available on most of the publicly traded stocks you're going to find here on Google Finance. So you might need to watch this video a couple times to truly like conceptualize it and remember all the 7 key points there. But it's revenue growth, net income growth, profit margin, cash versus total liabilities, the price to book ratio, also really important, cash from operations, free cash flow. Those are the 7 points right there. So happy trading. We're going to go over this maybe on Thursday after the NVIDIA earnings together so we can compare this quarter, this last quarter's earnings, Q2, versus the earnings they're about to report this week, the Q3 earnings, and we can see what's changed, and then we can, whether the stock goes up or down, we can understand why the stock went up or down. That's all I got for this episode. Tonight, I'm going to post a video that is going to break down those 2 swing trades that we're prepping for this week, and actually how we're going to pull a bunch of money out of the market this week with all the volatility and the NVIDIA announcement and the non-farm payroll announcement on Thursday morning. Please hit subscribe. We are giving away a 1 ounce silver coin as soon as we hit 25 subs. I think we're at 18 or 19 right now. So would love a sub, and then we'll continue learning and trading together. Thanks so much.